Passive fund or index fund can be defined as a mutual or exchange-traded fund with specific rules of construction that are adhered to regardless of market conditions. Equity index funds would include stocks of companies in particular geographical locations, for example the US, Europe or Far East Asia. Additional indexes within these markets include segments such as small value or large growth stocks. Securities are purchased and held within a fund when they meet that fund's specific parameters and sold when they move outside those parameters. Think of an index fund then as a rules-based investment vehicle. One of the advantages of passive investing when it's done properly is that it takes human emotions out of the equation. Emotions can have a very detrimental impact on investment returns.
Gambling generally has to do with a situation where there's a 50-50 bet of an outcome. It has to be close to an equal wager, or you wouldn't get two sides to the gamble. Those offering the bet, those taking the bet. The analogy for the stock market is we have fair prices which are achieved by millions of traders in publicly traded markets around the world. And those fair prices actually set up a scenario where it's an equal 50-50 bet as to what's going to happen in the very short term. This creates an action opportunity, which is the addictive component as described by Gamblers Anonymous. Now, Barclays actually did a study on this, and they determined over a 10-year period, those who let their emotions drive their investment decisions cost them about 20% of the possible return they could have earned over that 10-year period.
Experts in behavioural finance have identified a number of behavioural biases to which active investors are prone. One of the most common is overconfidence, expecting better returns than you're likely to achieve. Another is hindsight bias, thinking that past events were predictable when in fact at the time they weren't. And then there's regret avoidance, vowing never to repeat the same decision if it once resulted in a big loss or missing out on a significant gain. Behavioural biases such as these cause an investor to think they have an element of control in areas where actually they have little or none. Passive investors choose to stay invested all of the time, regardless of the market conditions, because they know that short-term volatility is unpredictable. To help them manage their risk, most of them rebalance their portfolios perhaps once or twice a year.
Rebalancing is sort of the antithesis of what the emotional investor would prefer to do. Most emotional investors think there's a trend from the past that will continue in the future. So if you started off with a 50-50 portfolio, and let's say your stocks went up, the active investor often thinks of that as a buying opportunity because something has gone up. But the rebalancer, or the unemotional, disciplined investor, says that that's an opportunity to get their portfolio back in balance, which means you actually sell some of that position that has gone up. And the same is true on the opposite. If your equities have gone down, the emotional active investor often thinks that's a signal they should be selling, but the disciplined, unemotional investor says, I need to buy more of those equities now to get back in balance. And that's actually a much better strategy because you've maintained your risk exposure.